Good afternoon, everyone. It is April 9, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Market Strategist. Before we start, please note that this event is for Morgan Stanley institutional clients and financial advisors only. It is not for members of the press. If you're a member of the press, please log off and reach out separately. Please also note that this webcast and recordings may be recorded. Today we have Chetan Iyer, Chief Asia Economist, Maya Mashwari, India ASEAN Energy, Chemicals, Materials, and Utilities Analyst, Daniel Blake, Head of Asia Thematic Strategy and Asia EM Strategist, Lawrence Tam, China Healthcare Analyst, and also we have Alice Sullivan from Asia Derivative Flows and Wealth Sales from the IED desk. During this session, you can send the questions at any time from the Ask a Question text box. So following the ceasefire agreement, there's still a lot of uncertainty on the ground of duration and whether the Strait of Hormuz will open. So first up, we have Chetan here with us to share his views on growth and inflation, and then what will be the damage to economies, and then which economies will see more relief on concerns, and then whether what's your views on supply chain as well. Over to you, Chetan.
Yeah, thanks, Crystal. So look, I think first let me just sort of add a few points in terms of our thinking on how we should think of the developments that have happened over the last 2 days or 1.5 days on geopolitical front, and therefore the implications of that on oil prices and our growth forecasts. So first up, I think there are 2 points which struck me as important, which increases the chances of this peace deal happening. Number one is that China eventually has got involved. What we hear from media is that Iran eventually got that nudge from China to sign off on the ceasefire deal. And that's a good sign. We think that actually is going to increase the chances of that peace deal. Second point is that Trump himself in press interviews has mentioned that there is a confirmation that they have got from the Iranian side on nuclear fissile material being addressed. And in fact, Trump said that if that was not assured, he would not have agreed to this ceasefire deal. So those 2 factors make us believe that there is some genuine reason for markets to be optimistic. Well, if that is the case, then you can operate with an oil price scenario which we just built into our base case forecast. So let me just now share the oil price scenarios that we have built into our forecast. So the first assumption is that you will have an average oil price of $110 in second quarter. You will see that will dip down to $100 in third quarter and then $90 in fourth quarter. And a peak of $110 on Brent is what will be the case. And then that's the middle column on this right-hand side slide. So if it is that kind of a path, then we think regions growth will be down by 40 basis points from 4.8 that we had in our tracking estimate before the oil price shock to 4.4%. So 40 basis points if oil prices are going to go at the peak of 110 and average around $100 in second quarter to fourth quarter. The alternative scenario is that if situation continues to be difficult, i.e. that traffic through Strait of Hormuz doesn't still open up, then there is a chance that oil prices rise to $150 in peak and average $113. Now, it looks like it's a smaller number, $113. That's because we have assumed that eventually there is some resolution. And at the same time, demand destruction will bring oil prices down to $80. So that's the $150 oil price scenario. And in that case, oil prices come down, GDP growth comes down to 3.9% for 2026 calendar year. And if you were to just look at 2Q to 4Q average, GDP growth in that scenario will be down to just 3.6%. And that 3.6% will be comparable to 5% which we were as a tracking estimate in first quarter of 2026. So from 5% in first quarter to 3.6 in the last 3 quarters is going to be a pretty big hit if our prices do peak out at 150. But right now, as of now, this is the base case that we are operating with, that it will peak out at $110. The question that you could ask is that current Brent futures prices are already down below 100. So isn't our assumption that we have made in this recent growth changes rather too bearish? But so on that front, I would like to highlight the point that you should look at the physical oil dated Brent price, and that as of yesterday is at 133. Day before yesterday, it was 144. And there's approximately a $30 to $35 premium over the Brent futures price that you see on Bloomberg. So we would think that this average of $110 in second quarter still makes sense, even in this optimistic scenario that situation is going to improve from here. Similarly, there is some damage that has been caused on gas supply front. So gas prices are also going to remain high through to the end of year. And therefore, we think that this downgrade that we have done is still pretty much fine. The more optimistic scenario would be that you might see this hit, but going forward, as we go through the third quarter and fourth quarter, and particularly next year, first quarter, growth rate should come back. So that's the main oil price related story. Now, I also wanted to bring in another point, which is that before this problem occurred, we were constructive on the Asian industrial cycle and capex cycle. And we think that as this situation gets resolved, that industrial cycle and capex cycle will come back with full vengeance. And the three structural drivers for that industrial cycle recovery were energy transition related spending, defense spending, and AI infrastructure spending. Now, this energy transition related spending and defense spending will get a double boost because of this geopolitical situation. And so we think that you should see the overall industrial cycle come back in a meaningful manner. And then there were these cyclical drivers as well. But in the interest of time, I'll skip that and just bring you to this chart, which is the evidence that we have so far on the industrial cycle. So the industrial cycle has been measured in our numbers by looking at the Asia ex-China industrial production. China we have removed because China is going through a compression in steel and cement demand production because of property, and it's not a reflection of the global industrial cycle. And parallelly to that, you can see CRB raw materials price index is also tracking and hugging in very closely. So this is the state that we were in before the oil price shock. And then the cyclical driver is captured in the non-tech goods exports for the region. And that has also kind of filled up quite significantly in the last 4-5 months. And so we think that as soon as that evidence emerges, that situation is continuing to improve, the corporate sector will come back with that capex effort, and therefore it will show up in the industrial cycle. So with that, let me stop here and hand it over back to you, Crystal.
Thank you so much, Chetan. And then Daniel is on the line with us as well. And then we published the reports yesterday. Can you share the market views and then your conviction level, and then also what themes to play from here? Over to you, Daniel.
Yeah, thank you, Crystal. So we have taken the decision, having sequenced our way through a very cautious stance initially when we saw the war break out in Iran, into a more neutral stance as of the second half of last week, where we said the risk of war was improving as we saw early signs of compromise and negotiation. And then just yesterday, we published a note advising clients to re-engage in risk and ultimately look for potentially a return to our base case targets, which are sitting with even after yesterday's rally, upside in the low teens. We're sitting at 12 to 14% upside to our base case targets for EM, for MSCI Asia Pacific ex Japan, for China, and taking Rhythm's target for India, we've got even more upside for Sensex. So as we look at this, we do think the inflection points that Chetan laid out are important for negotiations. The fact that we have seen both sides come together and negotiations starting or really progressing in Islamabad is important. Just showing that the relative costs of escalation for both sides compared with the difficulties of compromise and difficulties of off-ramp are pointing more towards that off-ramp scenario. And as Chetan lays out, we have got actors which are showing more a hand in de-escalating, but the risks will remain high. And we can see that the ongoing conflict in the wake of the ceasefire being agreed is showing that we may still see risks and efforts to try to destabilize this peace that's been initially agreed. So a lot to play for potentially, and I think Chetan laid out and sequenced very nicely the potential areas of leadership that we may see come back to markets in the wake of a reopening of the strait, and clearly that is going to be the feature we need to watch. In terms of the impacts here, what we'd point out is the excellent work that Mayank and Chetan have been doing on supply chains. The fuel supply situation in particular has meant that there is more economic damage and earnings damage that will be seen by markets like Indonesia, Philippines, Thailand. And so Southeast Asia is more negatively exposed outside of Singapore and Malaysia. And as we look at the themes and leadership to come back, we do think it's going to be focused on Japan, Korea, Taiwan, jumping out of the gates with the pre-existing themes of AI capex beneficiaries likely to be a key part of portfolio positioning into the second quarter. China also sees, I think, a couple of facets change in the wake of the Iran war, or as it's still playing out. First is the relative advantage of having excess capacity, in this case, energy security in place. And so as we're looking at the supply chain resilience within China, this may help to take market share, but the strong industry position China has in export industries into the renewable industry, energy storage, go to help the earnings picture here for parts of the China market. Again, coming back to that theme of investment and capital goods that Chetan lays out. So China is an equal weight for us. We still see deflationary pressures and margin headwinds for key parts of the market, but we will see maybe a little bit broader source of support for the market going forward. And then finally, there are some that have corrected more and may bounce back in the near term. If we're looking at the performance since February 28th, the numbers show that generally EM and Japan have had about a 10% correction, so not overly deep, but we have seen that more like 16% for Korea. Again, may jump out of the gates with both AI tech and industrial energy security spending benefiting the Korean market. And then also for Indonesia and Philippines, we've seen quite deep drawdowns, as well as for South Africa and the UAE. So within that, we do think we may get somewhat of a bounce, but in terms of the sustained leadership and rotation, we think it's going to come back towards these North Asian markets. So finally, in terms of the key thematics, we would point out that while we've got defence stocks still quite expensive, we do think the energy security thematics trading under 15 times is a good way to continue playing for the post-war outlook. It's an interesting way to approach the question, because it looks right across the value chain from upstream E&P through to the construction sector, and yesterday's divergence shows you that even with upstream names coming under pressure, the enormous rally we've seen in construction exposed names help to mitigate the volatility, and gives you a nice expression on what is the core thematic here. We'd also put clean energy and storage, nuclear and critical minerals in these related buckets that we think have got a good risk reward from here. So let me pass back to you here, Crystal, and thank you.
Thank you so much, Daniel. And then next, we have Alice from the desk as well to share trade ideas, flows, and investor feedback. Please note that Alice Oliva is a member of the Morgan Stanley Institutional Equity Division and not of the Research Division. His views are his own and may differ from those of the Morgan Stanley Research Department. Now, without further ado, let me pass it to you, Alex.
Thanks, Crystal. So just looking back, the key message from our early March oil shock discussion on derivatives desk was that Asia traded for a classic stress sequence, which is shock, crowded position unwind, and then hedge rally. Early winners were kind of intuitive with the hindsight, such as energy, shipping, and selected defense, while crowded growth and cyclicals took the major hit at the peak stress. Of course, the leveraging basically showed that while correlations spiked to 1, how unreliable broad hedges become in capitulation. And once conflict escalates, and that took 1 month to realize, we expected a fast positioning-led rebound. Now, as the positive de-escalatory news hit the tape, we want to look at the potential movers on the upside. And ideally, we look for 3 checkpoints, such as those where positionings got washed out, those sectors that have intact fundamentals, and those that have a geopolitical narrative backdrop behind them. Now to the flows discussion we had on the desk yesterday, post the ceasefire announcement. At first, we start with the broad country indices upside. And it was surprisingly to see that investors were playing upside pretty much one way through China A, as opposed to wider region, despite, say, Korea and Japan were generally perceived to be more snappy on the upside in that scenario. Obviously, there's a price component to that. China A indices volatility is much cheaper, given relatively more gradual sell-off on the iron conflict. Also, for those who trade China A indices regularly, the repo rates are set at attractive levels, providing attractive pricing on both options and outright Delta One index exposures. For example, you get paid 11% on top of the index performance just to hold China CSI 1000 for 1 year on swap. Besides pricing, there's a macro narrative of Trump in May, where China is seen to get some concessions out of US, and macroeconomics-wise, China is seen to move from broad deflation to patchy disinflation and even partial reflation. So in summary, China A is at oversold levels, macro geopolitical catalysts, macroeconomic catalysts. Hence, it was preferred as an upside play yesterday over Japan, Australia, Korea, Taiwan, which are all set at oversold levels, but with no new major macro catalysts upcoming. Having said that, people do acknowledge the structural upsides and bull stories in Korea and Japan. Zooming into country-specific sectors, the price action is self-telling. The crowded, well-liked trades of January that sold off on degrossing leading the charge. Japan, high beta cyclicals, Korean memory, Taiwan AI-related tech, Australian miners were like at the top of the discussion among investors yesterday. While all this thematic sold off, there's a sense that the positioning was and still is there in those sectors, and now market is just reiterating its conviction. We're also receiving a lot of inbounds on the trades that were specifically disliked in January on the back of momentum unwind, and now turning from even more oversold levels, such as China AI. There are heavy investments in the sector, akin to what was happening in US AI infrastructure build out in 2023, 24, and 25. So in China, we have private hyperscales, Alibaba, ByteDance, Tencent, and Baidu spending aggressively on cloud chips and compute, while state local governments are funding intelligent computing centers and steering procurement towards domestic chips. Some people see this capex expansion as a reflationary driver for overall China economy. As some of us may remember that back in 2025, reason US growth held up was primarily because of the AI capex, and many people who we talk to, clients, accounts, think similar stories are unwrapping in China. Moving on to another new trade in town, India is a still growth economy, but January momentum unwind and then the geopolitical shock, they hit hard. Now as we stabilize, macro positioning looks strong. We get further confirmation on peace talks. If we get that, external vulnerabilities will be priced out as well. In India, we like broad index upside here. Then US, specifically AI infrastructure and semis, have come up quite a lot in our discussions with the capex intact. And the reason basically those trades were unwound is because of the January momentum unwound first, and then geopolitical risk. And most of that damage has not been undone yet. So to sum up, so we have 3 buckets on the desk that we're discussing. As a broad index, China A, as a macro catalyst and attractive pricing. Number 2, January well-liked trades, such as miners, Japan high beta cyclicals, Taiwan AI related, as a consensus reiteration. And number 3, newly liked thematics such as China AI, India, and US AI infrastructure and semis specifically. And as always, we're happy to chat more on these thematics, and we have a broad tool set for monitoring these trades and wrapping them into defined risk targeted plays. And I yield back to Crystal. Thank you.
Thank you so much, Alex. Just a very quick question for you here. Because actually, ever since the conflict started, we haven't really seen a lot of meaningful degrossing for the whole of March. And then we only saw minis adding shorts. And then the degrowth only started from the fourth week. So for yesterday activity, how did you see the concentration? And then have we already exceeded the level that we have seen before the conflict? Like people are getting even more bullish afterwards?
Sure. So on derivatives desk, we usually see the tactical plays and maybe a little bit longer tactical plays. So of those, we have seen a lot. When it comes to outright Delta One plays where people place long-term bets, sticky capital kind of thing, we have seen a comeback, but I would define it probably 4 out of 10 in terms of aggressive regrossing on exposure. And I think the reason to that is just peace talks and sort of de-escalatory tape that we're seeing is just a beginning, and the sticky capital needs some of the time to confirm that, while tactical expressions tend to be a bit more aggressive in the meantime.
Got it. That's super clear. Thanks so much, Alice, for joining us today. So now we are moving on the energy side. Today we have Mayan with us to share his thoughts on the energy space. And then are you still bullish on renewables?
Yeah, Crystal, thank you. So I think just to give a bit of a perspective around how we are thinking on the entire energy downstream space post post this shock, how it will kind of evolve. I thought I'll share this one chart which basically tells you the amount of disruption and impact on capacities that we have seen around the world across oil, natural gas, fuels, chemicals, plastics, fertilizers, helium, sulfur, which is the tech supply chain. And what you will see here is on the third column, about 20% of natural gas capacity has got impacted, which is not going to come back in the next few years. 5 to 6% of refining and fuel capacity has got impacted. Half of it may not come back in the next year or so. And about 20% petrochemical and plastics capacity has got impacted, which will take at least a minimum of 6 months to kind of come back. If at all of it comes back, we think around 8 to 10% may not come back at all because restarts get pretty expensive in some of the countries. And then fertilizers, I suppose, is going to get impacted as well. And then I think the second derivative impact in terms of helium and sulfur will show up if less refining capacity is there in the world. So beyond the war and beyond this risk event, we basically continue to see a lot more tightness across the downstream energy supply chain. Chemicals as well as fuel refining is a place where we think there is significant upside to consensus estimates coming through even beyond the war. And more importantly, the way you are looking at this is incremental supplies coming at the higher end of the global cost curve, which basically means margins for the existing players are going to go pretty high. So that's on the energy side. If you go into more on the power side, and Crystal, to your question around renewables, the way we are thinking through this is most policymakers in Asia are going to focus on baseload supply of power rather than the intermittent supply of power. So on a relative basis, we think coal and nuclear is going to be the next big place where you will see incremental investments come through. Obviously, nuclear has been a focus for policymakers because of the powering AI story and the data center capacity growth in this part of the world. But nuclear takes around 8 to 10 years to kind of come through. That's why coal will be the much quicker fix. And some of the countries and economies have coal-based power generation, which can be kind of fired up reasonably quickly. We are seeing that happen in Thailand. We are seeing that happening in Korea. And you are seeing utilization rates of existing coal plants being lifted up in other parts like Indonesia and Taiwan as well. So when you think through this, I think coal demand will surprise on the upside from a power perspective. And the next place where I think you will see a much quicker fix to kind of address the shortage of power problem will be through batteries. So I think energy storage is going to get a quick demand growth coming through over the next 1 to 2 years as such. And then I think consumption in power is going to kind of go higher in Asia as well, partly because the spillover effect of data centers, which are kind of going to show up in this part of the world. And finally, I think on renewables, I think renewables will have to work together with nuclear, coal, and batteries to increasingly kind of help the baseload supply grow faster. So that's the way we are kind of thinking through across the energy space right now, beyond the shock. I'll pass it back to Crystal.
Thank you so much, Mayan. And then now we are moving on to the next topic, which is on China healthcare. The US-China summit is scheduled to mid-May right now, and then today we have Lawrence Tan with us to share his outlook on the impacts on China CDMOs, and then broadly the reads from the tariff headlines. Terence, I think you are still, Lawrence, I think you are still on mute. Try again. The audio still doesn't come through. You can try to log in again.
Hello.
Yeah, now we can hear you.
Hi. Okay, sorry. I was trying to just share a recent note on the Trump-Xi summit. Let me talk through how the Middle East crisis is relevant to China healthcare evaluations, in particular for China CDMOs that depend on U.S. revenue. So the top Chinese CDMOs depend on U.S. customers. They derive anywhere from 60 to 80% of their revenue from U.S. biotech or pharmaceutical companies. And since the first Trump administration through to the Biden administration and the second Trump administration, the U.S. has really come down hard on our sector in terms of sanctioning of certain companies and in terms of tariffs. And I think the improving relations between China and U.S. would have a bearing on that turn out to be. So just to give you a few examples, the Biosecure Act, which almost got enacted into law at the end of 2024, was toned down in the last session of Congress. In the last defense bill that was passed, naming of Wuxi companies was dropped from the Biosecure Act. So I think that was one concession that the U.S. made against to China. And the tariff rate, which many people dubbed the fentanyl tax, was originally 20% on top of the low single-digit tariff on Chinese APIs and generic drugs. It was lowered from 20% to 10% in November as a result of improving relations. So that's point number 2. And point number 3 is the recent Pentagon list that was released in the past 2 years to sanction certain Chinese companies. It was shortly released and withdrawn in February, I think also due to improving relations. In the original list, some of the top Chinese CDMOs were named on that list. And that list is now delayed indefinitely, I think partly due to the upcoming conference between the two leaders. So I think overall, the U.S. has made certain concessions to Chinese healthcare companies, which is good for Chinese CDMOs. That being said, with the escalating situation in the Middle East and the dollar depreciation, that has affected how CDMO valuations are doing, in particular because they rely so much on U.S. denominated contracts. That FX impact has had a negative impact on their earnings results. The other aspect is their investments in the Middle East have been affected by the unstable situation there. For example, the Wuxi companies have been making capacity expansion investments in the Middle East, and now those plans are being delayed. So I think how the Trump summit turns out in mid-May will have a huge impact on how CDMO valuations trend. They have all issued very strong backlogs and guidances for 2026. So fundamentals are really strong, but their valuations are hitting a ceiling because of the geopolitical crisis. I'll hand it back to you, Crystal, for Q&A.
Thank you so much, Lawrence. And then now we will have the Q&A session. The first question is for Chetan, because overnight we have seen the tanker turning around, and then still there's a lot of uncertainty on the ground here. So what's the timing for the flows of goods to return back to normal in your view? And then how much supply chain damage has been done? Also, what's the assumption that we have used in the gross inflation forecast in the reports?
Yeah, so for the oil price part that I mentioned, $110, $190, what we have assumed is that 80% of the traffic gets normalized 80% of the traffic comes back in the Strait of Hormuz in a month's time, and then in another 2 months' time. So in all, in a quarter's time, you get near normalization of traffic through the Strait of Hormuz. And of course, if this doesn't happen, then the oil price assumption itself will have to change, and therefore our growth forecast will have to be accordingly adjusted. The gas supply is sort of already done. We've not made any change recently, but when the Qatar gas field was affected, Mayank and his team made the change on assumption of how much gas supply will be restricted, and so therefore we have built in a $30 of gas price in 2026. So that's the assumption on the supply front on gas that we have assumed. Of course, any changes there and additional damage will accordingly affect the forecast and assumptions for gas prices as well as the quantity of gas that will be available.
Thank you, Chetan. And then also there's another question for Lawrence here. So how dependent is the US structurally on China drug manufacturing?
So I think we can separate the question into two buckets. So on the generic side, which includes the APIs and the formulations, the U.S. is highly dependent. I should say globally, countries are dependent on China for intermediates and APIs. These usually get processed into formulations in India and partly Israel, into generic medications that get shipped to Europe and to the US. So that's one reason that after COVID, the US and European governments came out with a series of initiatives and studies just to look at how dependent their supply chains were on China supply. COVID was a high point. China shipped a lot of APIs and essential medicines to US hospitals. So the US is highly dependent on China. It's somewhere between 30 and 40% by volume of generic APIs are shipped out of China. So that's on the generic side. On the innovative drug side, the US is also highly dependent on Chinese R&D and manufacturing services. For example, the WuXi Group derives over 70% of their revenue from US biopharmas. During the height of the Biosecure Act, many US biotech companies and pharmaceutical companies wrote to Congress lobbying against inclusion of the WuXi companies in the Biosecure Act. So that just shows you how dependent the US companies are on Chinese services and how efficient China is as a base for R&D.
Thanks, that's super clear. And then in the interest of time, we'll conclude today's webcast here and then also answer remaining questions offline. Thank you so much for joining us, and do reach out to me and the team if you have any other questions. Have a nice day. I will see you next week.